Yeah, I'm losing my edge.
Hedging out U.S. dollar risk is the topic of conversation here today, Pete. U.S. dollar, as many people know or maybe don't know, is priced into a lot of products that they trade. And you and I forget this a lot of times because we deal in dollars here in Chicago, although sometimes Pete likes to joke that where I come from on the south side of Chicago, Beverly is its own country, or what do you like to call it? It's a principality or something?
It's like Monaco. It's a principality with the Beverlovian shekel.
The shekel, yes, which isn't a real thing. But no, we deal in dollars here in Chicago. So we sometimes forget about the fact that there are international viewers and international accounts that deal in U.S. dollars. So we're going to get into all of that here today. Without further ado, let's take a look at the small USD contract. SFX futures, Pete, offer a lot of speculative opportunity on their own. Before getting into hedging out the dollar, why don't you do a little bit here on just how this product functions and how you, as someone who, born and raised here in the U.S. and came up here in Chicago trading foreign exchange, how do you use the U.S. dollar, Pete, as a futures trader?
Well, you know what? It's so funny because I think I started my first, again, dating myself, when there was a D mark before we went to Euro currencies. The idea, and I think so many traders kind of miss this part of true diversification. What do we own most of? It's not our overweight gold position or our crude oil position or our U.S. equities position. It's dollars. Everything we trade is priced in dollars, and it's driven by a number of different factors, a lot which we don't digest every day or want to. It confuses the trade. But the U.S. traders are the most inward-centric traders in the globe. You go over and you talk to guys in Europe, guys in Asia, they realize the global nature of markets. And this dollar exposure we have is probably one of our biggest exposures. And there's a lot of us who don't really ever trade that exposure. And it's interesting because we got a request to speak to this because there are traders that fund their account in U.S. dollars but live in a foreign country, which means everything they consume and do is denominated in that currency, whether it be Canadian dollars or Australian dollars, but they fund their account in U.S. dollars and the effects of that on their portfolio. So trading, and this is another piece of that diversification we talk about, which is what's wonderful with futures is you can truly talk about diversification, and it's not just trading some Amazon and some Chevron is my diversification. True diversification comes from products that don't have a lot of correlation, that move independently. And the dollar is one of those pieces that's so important. But the complexity, and for me, it's interesting, Frankie, and I don't know if this is that interesting to others or not, but there were 6 currency pits when I started. And it was a dilemma for me just to pick which pit to go into. I picked the wrong one. It was where all the gunslingers were, and they were throwing around 100 lots, 200 lots, and the market was moving 200 points a day. And one of the guys took pity on me, tapped me on the shoulder, and said, "Son, I don't think this is the right place for you to start." And I moved down the road to another pit that fit much better for my size and my comfort level, just like smaller products. So there was an early case of picking the wrong product and picking one that was too big and too volatile. Being able to size a product and get that type of exposure and start to realize how important the dollar trade is to everything else we do, it's really, it's that next level of diversification and empowerment everyone should think about.
Yeah, and I'm glad that that's a great little story and great ideas for using this market as that first opportunity to just put an opinion into the foreign exchange world. I think foreign exchange is kind of a cultish asset class a lot of times, Pete, whether it was the pits that you walked into a couple of decades ago or right now even. I think there's a lot of like, oh, you need to know everything about Forex to step into these markets. What's nice about this small U.S. dollar, it is just U.S. dollar against euro, Chinese renminbi, yen, a bunch of other products, but it's still at the end of the day, we only did that to diversify it. So you got one central US dollar to trade. So a great spot when looking to add this asset class for speculative reasons. But Pete, I want to go deeper on the fact that US dollars are built into so many products. And, I can crunch the numbers, I can present the information here, but at the end of the day, I want you to give more of that experience, that context to the fact that, why is the US dollar negatively correlated to gold, grains and crude oil. And you see, especially with grain markets like corn and soybeans,
Right.
a strong negative correlation, and similar to crude oil, not so much in gold, but maybe give the backstory to why this is, and then go deeper on these specific other products that U.S. dollar does affect at the end of the day.
Sure. So, you know what? When we look at the global trade of equities, I think grains is a great example. So, the U.S. is still the largest producer of corn in the world. We're no longer the largest producer of soybeans. It actually is Brazil. So when the world who buys grains looks at it, it's where can we find the cheapest price in grains? And as the dollar fluctuates on a global scale, it makes our grains look expensive or look cheap to the rest of the world in comparison to the Brazilian real and its grains, or the Argentinians and their peso. So the ebb and flow of the value of the dollar, and thus our dollar-based commodities, are very correlated. So an expensive dollar will lead to a lower price in grains. So because it's making an expensive dollar, it makes our grain products more expensive on the globe relative to our competitors. So how does that adjust? Well, our grain prices come down. So the impact of dollar flows directly impacts each and every one of these commodities when you think about it on this global level. And the one thing, I'm trying to keep this a short explanation. Don't get consumed by that, trying to triangulate arbitrage between the real, the dollar, and soybean prices. Just remember the context around that the dollar is an important component. It's not when they plant beans and when they harvest beans in the U.S. Things like the dollar are an important component in pricing as we move through the trading, as we move through every day of trading. So keep that context in. And that's why we see all these. I mean, look at that 0.6 negative correlation to crude oil. Lots of different drivers to crude we know every day. Lots of opportunity there. But this dollar component, when we reach these extremes in the dollar, you start to see this reflection, and this correlation kind of really, this negative correlation really is a very stark contrast to what we can see. So it's important to be mindful of this in a larger context of how we trade. You would think, okay, I'm going to trade gold and not the dollar because it's a different occurrence and a different product. It certainly is, but there is an underlying relationship between the two that's really important for us to understand. And I think what Frank is going to walk us through, a very interesting tradable opportunity.
Sure, because you look here, and this is even the weakest correlation between the three that we just posed
Right.
there. Gold versus the small U.S. dollar here for the last year's worth of trading. And though this trade is absolutely imperfect, I mean, negative 0.3 correlation, Pete, that is not very strong. But what's interesting, and you and I'm glad you brought up the word arbitrage, because I would never, especially as a non-professional, someone who isn't in that market-making chair with micro millisecond data coming through and these big advanced trading systems, I would never advocate for a retail person to look at arbing the dollar against gold and its effect on there. But what is interesting is even with the weakest correlation here, gold and the U.S. dollar, you see the long-term trending of these markets, moving off of each other. You see since the highs here in the U.S. dollar in March, amid pandemic news coming out, it's been almost nothing but downside in U.S. dollar, aside from a few bounces, and vice versa. You see the same timeline, almost nothing but upside in gold. Now, of course, that imperfection kicks in where the highs in gold were actually here in August, and the lows in U.S. dollar are actually as recent as just a couple of weeks ago. So it isn't perfect, but it does present an interesting trade, and one that you and I, and as so named the segment here for today, we use dollar against gold or crude oil, Pete, a lot of times as like a hedge. It's almost like if you're long gold and the market moves higher here, you might get long some U.S. dollar. Do you want to talk to the potential opportunity? Because it's not an arbing this on a minute by minute basis, right?
Yeah, and you know what? I reticent to even mention the term arb or arbitrage, because that's not what we do. And you know what? I get so many emails about, well, what's a great book to really dive into FX and understand those mechanics of interest rates? that's just it's if you're willing to read that because it's an interesting economic read and then compartmentalize it, that's fine. But that's not what we base our trading on. The tradable opportunity here, and I like the fact, Frank, you pointed out a negative 0.3 correlation. Not that strong when we talk about the world of pairs trade, but we know that this is a relationship, but it's not the sole driver of the relationship, which gives us an interesting tradable opportunity here. One won't peak when one troughs perfectly. That's not the case here. But the opportunity to look at that context of the dollar, and you know what? Think of it as simply as this. If the dollar falls, I can buy more ounces of gold with my dollars than I can the more expensive euro or the more expensive yen. And that is where we see that correlation that makes perfect sense. All right, if the dollar's cheaper, I can buy more ounces of gold with that amount of dollars in comparison to the currencies that are richer. So just that's the opportunity. Don't go any further down the rabbit hole than that. And I like the way where you said, and this is so important. How do I add duration? How do I add another set of strategy to an existing metals position? And that's where this dollar becomes a really interesting trade.
Yeah, and here are the ratios for hedging this dollar risk out of products like GC, ZC, and CL here, because what you'll notice is foreign exchange products much less volatile than other asset classes.
Right.
And with that in mind, I'm looking at hedging the notional amount here. 13 SFX gets you to about 1 GC contract, which is how I would think of this, right, Pete? Like, say GC has a volatility of and we're just talking about gold here, has a volatility of 15, 20% or whatever. Corn, we've seen, especially recently, can have volatilities closer to, 30, 40%. Right. Same with crude oil, as we saw a little bit midway through last year, huge volatilities over 100%. The US dollar usually having a volatility coming in at single digits. And so what you're doing by, and Pete, great example there. That's a great way to put it, is extending duration in your long gold trades or your long corn trades or your long crude oil trades by buying some US dollar in there against those longs and hedging out a few percentage points of that volatility there that you're speaking to there, because it's a matter of gold moving, this gold contract moves about like $1,000 per day, or at least a few $100, and those 13 SFX are going to hopefully hedge out 10% of that. And you don't have to do the 13. I actually wouldn't probably. I would just do a few for each of these different markets, maybe one for corn or one for crude oil.
Yep.
And it's just a matter of, it's a long or short trade, because when you buy GC, you're buying gold in US dollar terms, and then you hedge out a little bit of that. Do you want to speak to that opportunity here with the ratios up?
Yeah, and I agree with you. From a trader standpoint, my strategy is to be long spree. So what are my mechanics? I'm going to give myself, and I like what you hit on. We always talk about giving ourselves some cost basis reduction, and we've shown that using options on futures as a pair. But the slowing the volatility or the movement of that gold by putting this piece against it is that same form, along the same line of that cost basis reduction. I'm slowing the pace of that movement if I'm wrong or if I'm right, which is a good thing, because then we're smoothing out returns. Yeah. I agree. I couldn't agree with you most. My mind goes to 6, 1, and 2. So we're always cutting them down, because what we're looking to do, it's not consume our idea, but to extend our idea. So those are the tradable ratios for me.
And use today as an example. You've got gold. Pete, you probably have your quotes up in front of you. I can't with the shared screen here. But gold is up like what, $10, $15?
Gold's up, again, funky gold settlement prices.
Sure.
It's up $17 from where we went out the day at 4 o'clock. Yes.
That's fine. Okay, so gold, they're up about $1,700. Right. And if you had SFX is down, I think about 30 cents today. And so if you had, a few SFX there, you were long gold and long SFX, that's the trade long or short, then Pete, you'd be up about, $1,500 to $2,000 in the long golds, and you'd be down a couple bucks in that SFX position. Right. That's and you'd say to yourself, well, why do I even add the dollar? Because if I'm long gold and tomorrow it moves down by, $5, $10, $20, you would hope with that correlation historically that the dollar position is up. And so that's the slowing down, adding duration. And same with crude oil up a little bit here today. The only thing, and I'll note this, that these, and I said this back here, these relationships are imperfect. You've got days like today, and I know corn and ags are bouncing back right now, but corn down today with US dollar down. So this isn't that perfect trade of, I don't even know what you would think about, like the S&P 500 against all of its like top 10 stocks. It's not perfect, but it is a way to slow down these markets.
Absolutely. And I just want to point out really quick, we're talking about a trade that smooths volatility. So often our pairs trades are buying one, selling the other, as you would do with what you pointed out, an arbitrage against the top 10 stocks and an index.
Sure.
Here, anything with a negative correlation, guys, is always buy, and sell. Yep. That's the way we take advantage of it. So just jot that down. When you look at negative correlation and you're looking to trade that, it's a buy, sell trade. So you're absolutely right, Frank. The point is, this doesn't care if I'm out on my gold trade. I'm not always guaranteed a return on my dollar trade, but consistently over time, it is a great way to slow the pace of the movement down and give time for your strategy, which is either, for example, long metals, to work in your favor. And you know what? This is what I love about the dollar index is, could you pick euros, sterling, or yen and do the same trade? Yes, because they're part of the dollar puzzle. They're not a complete part of the dollar.
Yeah.
I think the dollar index takes, I don't want to have to be the currency picker. I want the tool of the dollar to put against these positions. It creates a more elegant trade. Actually, that's a lot simpler to implement.
Absolutely. And the last piece here, Pete, and I'm going to just clear out here and let you go. You don't have to go deep on this, but this was brought up in an email from a great viewer of ours, Daria, for those international accounts who are translating their currency from Canadian dollar, Australian dollar, wherever you are on the planet, to US dollars. I have some ratios up here, and you might say to yourself, oh, $15,000 account, one SFX. So I have to hold, about $15,000 of US dollar here for that. Keep in mind that one SFX, the margin is around $200. So I'm not saying that you need to put all your money towards this dollar position, but this is how you would look at hedging that risk. And Pete, I'm gonna make like Shaquille O'Neal, and I'm just gonna clear out the floor here and let you talk about hedging out portfolio risk for an international account.
Well, and again, you're right. And Frankie has not going down the rabbit hole. So international based accounts, and U.S. traders never think about this because we fund our account in dollars, and everything we trade is denominated in dollars and settled. Our P&L every day is in dollars. Well, a foreign trader, and let's use a Canadian trader, will take their Canadian dollars and fund their trading account in U.S. dollars because that's the way all the products are denominated, and that's the way the statement is settled and cleared every day. So what's the risk for them? Well, let's just say they put $100,000 into account, and the Canadian dollar is trading at 120. So takes a 1.2 Canadian dollars to fund every US dollar. So they put $100,000 into their US based trading account. Now, let's say that account stays the same, but the Canadian dollar falls from $1.20 to $1.10 to 1.1 from 1.2. Well, if they were to convert that 100,000 US back into Canadian dollars, they would get $10,000 less Canadian dollars. So you see how the impact of movements in foreign currencies can directly impact their returns from trading US-based products. So I want to implement my strategies. I want to have my bias and see how the returns on capital work. I don't want this exogenous piece to affect my returns. So how do I do that? I hedge that piece out. And using SFX is the way to do that. I want to take out that random currency component from my dollar-based trades. This is what we want to accomplish. I don't want that housekeeping headache. This is how we do it. We take that component out. It's pretty straightforward how we can do it. And I think, Frankie, you hit on the key piece. What am I going to have to do? How laborious is this going to be? And I always think as a trader, laborious one is learning. More laborious is how much capital I have to do this.
Sure.
What do I have to not trade to be able to do this? At $180 a contract, this fits into that not laborious bucket.